Introduction to Asset-Backed Securities. Here are the major sections in this reading. At the heart of asset-backed securities is the securitization process. What we'll do here is understand a very simple securitization scenario and also familiarize ourselves with some of the most important terms. The securitization process involves pooling relatively straightforward debt obligations such as loans or bonds and using cash flows from the pool of debt obligations to pay off the bond created in the securitization process. Let's say that we have a large financial institution that issues mortgage loans. This financial institution will then have several mortgage loans as assets on its balance sheet. Say that these mortgage loans are pooled together and sold to a special purpose vehicle. So now these assets have been transferred to the special purpose vehicle. So each of these is a mortgage loan and they have been pooled together. Now, when homeowners make their mortgage payments, those payments come to the special purpose vehicle. This special purpose vehicle issues bonds called mortgage-backed securities, and the payments to these bondholders come from these particular assets. And now this definition will make more sense. So notice that this process, the securitization process, involves pooling together debt obligations. The debt obligations here are mortgage loans. The cash flow that comes in, these are payments from homeowners, are used to pay off the bonds created in the securitization process. So these are the bonds that are created in the securitization process, and cash flow coming from the homeowners, the mortgage payments, are being used to pay investors who have purchased these bonds. So we've understood, at least at a very simple level, the securitization process. Now, the distinction between asset-backed securities and mortgage-backed securities. Asset-backed securities is a larger term which deals with any security that is created by this sort of a process where the bondholder or the security holder is paid based on cash flows associated with the underlying asset. Now, the largest category of asset-backed securities is mortgage-backed securities. In other words, securities where the underlying asset is some form of a mortgage instrument. Since this is such a large market or such a large segment of asset-backed securities, often we talk about mortgage-backed securities as a separate class altogether. But at least conceptually, they are also a type of an asset-backed security. And the final term that we'll discuss on this slide is securitized assets. These particular assets that are used as collateral for the asset-backed security, these assets are referred to as securitized assets. Let us now consider the benefits of the securitization process. One major benefit is that securitization enables investors to get direct access to liquid investments and payment streams that would be otherwise unattainable. To understand this, let's consider a scenario without securitization. We have a large bank which issues mortgage loans to homeowners. Let's say that there are several mortgage loans issued to many different homeowners, and then homeowners make mortgage payments. You are an investor and you want to participate in this market. So you would like to make these sorts of investments, mortgage-oriented investments, so that you receive a stream of mortgage payments. Obviously, it is impractical for you as an investor to go make individual investments here. So it will be extremely difficult to find the right homeowners to assess who can make payments and directly make investments with particular homeowners. Also, this would be very risky because you might make a particular investment, issue a loan, and then that particular homeowner might default. So that's not practical. You could indirectly participate in this process by having some of your money at this bank and by buying shares in the bank. But notice your exposure to this underlying pool of assets would be indirect because there are many other factors which will impact the market price of the shares of the bank, for example. Now, with securitization, to a large extent, the role of the bank is reduced, and when the role of this intermediate entity is reduced, that's referred to as disintermediation. How does that happen? As we discussed on the previous slide, if all these mortgage loans are pooled and packaged and sold to an SPV, and the SPV issues mortgage-backed securities with the loans as collateral, now through this mortgage-backed security, you as an investor have almost direct exposure to this particular investment. So that is what's meant over here. Securitization enables investors to get direct access to liquid investments and payment streams that would be otherwise unattainable. So now, by holding on to this mortgage-backed security, you get access to the payment stream that is coming from homeowners. Let's look at another aspect now. Securitization enables banks to increase loan origination, monitoring, and collections. If you think about the overall process, given that now a large number of investors would be interested in the asset-backed securities or the mortgage-backed securities, this means that financial institutions can raise a lot more money and use that money to issue many more mortgage loans. There is a lower cost of borrowing for entities raising funds, since a lot more money is involved, and investors now are happy that with the SPV, the specific mortgage loans serve as collateral, plus the mortgage loans are also pooled together, which creates a diversification benefit. For these reasons, the cost of borrowing for the entities which are raising funds goes down. In this case, the entities raising funds are ultimately the homeowners. So the cost of borrowing for homeowners goes down, which is a good thing. Higher risk-adjusted returns for investors. Given the relatively low risk involved over here, for that level of risk, the investors in asset-backed securities or mortgage-backed securities are getting a good return, so they are happy. Greater efficiency and profitability of the banking sector. This is a larger point. Generally, at least in the United States market, the mortgage-backed securities are extremely liquid. They have a good secondary market, because of which the financial markets become more efficient. And then there will be kinds of investors who are interested in different sorts of mortgage-backed securities, which enables a good matching of assets and liabilities. And while this subject is a little beyond what we need to know right now, but the simple summary is that because of these instruments, markets become more efficient and overall the banking sector becomes more profitable. In the introduction, we spoke briefly about securitization. Here in section 3, we will discuss the process in more detail. Specifically, here are the subsections we'll cover: an example of a securitization transaction, the parties involved and their roles, the types of bonds issued. Specifically, there are multiple bond classes that are often part of the securitization process. We'll talk about that. And finally, the key role of the special purpose vehicle. Let's discuss an example of a securitization transaction. Say there is a company called Mediquip. This company manufactures medical equipment, and this equipment is complicated and it is fairly expensive. The company sells equipment to its customers, but since the equipment is expensive, the customers generally buy on credit. This means that on the Mediquip balance sheet, we have several accounts receivables or loan receivables. What I have said so far is depicted over here. So this is the company, it originates loans, the company sells to customers, and obviously the customers are borrowing money from Mediquip. So lots of loan receivables on the balance sheet of Mediquip. Now Mediquip needs to raise money, so it packages these loan receivables and sells the loan receivables to an SPV. The name of that SPV is Medical Equipment Trust, or MET. This is a separate legal entity. It is the SPV. Obviously, the SPV is receiving or buying the loan receivables and giving cash to Mediquip, and that is the cash that is being used to fund the loans. Now, Medical Equipment Trust needs money, so what it does is it sells securities, asset-backed securities, to investors and receives cash from the investors, and then this cash is used to fund the purchase of loan receivables. Now let's look at how the investors in the asset-backed securities get their return. The customers who buy from Mediquip make their payments, so they make their interest payments and principal repayments. That money comes to Medical Equipment Trust because the loan receivables are actually legally the property of MET. So MET gets money from these customers, and then that money is used to make cash payments to investors. Let us now look at the major parties and their roles in this securitization transaction. The SPV, or Special Purpose Vehicle, is MET, Medical Equipment Trust. This is also called the trust. It is also called the issuer because this is the entity that issues the asset-backed securities. As far as investors are concerned, they are buying the asset-backed securities from the issuer. The seller of the pool of securities is also called the depositor. This is the company itself. It is Mediquip. This is the company that is selling the loan receivables to MET, or the issuer. Let's also understand the role of the servicer. Servicing involves collecting payments from borrowers, notifying borrowers who may be delinquent, and if necessary recovering and disposing the medical equipment if the borrower does not make loan payments by a specified time. Notice that in this case, when we talk about the borrower, it is the customers who are borrowing from Mediquip. So who performs this servicer role? In our particular securitization scenario, we are saying that Mediquip performs the servicer role because Mediquip is selling to the customers. They have direct contact with the customers, so Mediquip is responsible for going after the customers and making sure that they make payments. However, it is not necessary that in all securitization transactions it is the seller. However, it is not necessary that in all securitization transactions the depositor plays the role of the servicer. It is possible that the issuer become the servicer. It is also possible that a third party is asked to play the role of the servicer, and so on. But what you need to understand is that this is an important role, and obviously that role needs to be assigned either to the issuer or the depositor or some third party. There are several other parties that are involved in the securitization process. These other parties include independent accountants, lawyers, trustees, underwriters, rating agencies, and guarantors. And hopefully it is obvious why these other parties are needed. Clearly, several legal documents need to be created, because of which we have lawyers involved. There needs to be a credit rating associated with the bonds that are issued or the asset-backed securities that are issued. That's why we need rating agencies. The trustee is typically a financial institution with trust powers that safeguards the assets after they have been placed in the trust. From an exam perspective, while it's important to recognize that these other parties are involved, but it is critical that you recognize the role of the three major parties: the SPV, also called the trust, the seller/depositor, and the servicer. Let us now consider a real-world example of securitization. I want you to read this information and then answer these questions. You need to identify the collateral and the parties to this securitization. First, let's identify the collateral. Notice that you might be tempted to identify these items as collateral, but these are actually the asset-backed securities. The collateral is what is backing these particular securities, and that's given right here. The assets underlying the notes are fixed rate, simple interest, conditional sales, contracts, promissory notes, and security agreements relating to the purchase of new or used motorcycles. In simple terms, it is the loans that motorcycle buyers have taken out, and those loans are pooled together and packaged to issue these particular securities. So the answer to the first part is that the collateral consists of simple fixed interest rate loans. Now, who are the parties? The issuer is Harley-Davidson Motorcycle Trust. This is the special purpose vehicle, and the analogy would be that the SPV here is like MET from the example that we were just discussing. The seller and servicer is Harley-Davidson Credit Corp. You might have thought that the seller is Harley-Davidson Corporation, but it appears that there is a division or group under Harley-Davidson called Harley-Davidson Credit Corp. This is the entity that pools the underlying loans and sells those loans to the SPV. So if I were to draw this out, the seller is Harley-Davidson Credit Corp. This is the equivalent of Mediquip. This entity sells the pool of loans to the SPV. The SPV is Harley-Davidson Motorcycle Trust, and Harley-Davidson Motorcycle Trust is the entity that issues the asset-backed securities. So investors buy the asset-backed securities from the SPV. The servicer is also Harley-Davidson Credit Corp. So this is the entity that is responsible for servicing the loans, and we've discussed the role of the servicer on previous slides. Now we come to section 3.3, bonds issued. Up till now we have talked about simple transactions where the issuer issues one type of bond or one type of asset-backed security, but in the real world generally multiple classes of asset-backed securities are issued. The motivation for the creation of different types of structures is to redistribute prepayment risk and credit risk efficiently among different bond classes in the securitization. Prepayment risk is the uncertainty that the actual cash flows will be different from the scheduled cash flows as set forth in the loan agreements, because borrowers may alter payments to take advantage of interest rate movements. Now let's understand this. Say that MET, this is the SPV, issued the following 4 bond classes with a total par value of 200 million. Now it is possible that the customers, these are customers who bought medical equipment on credit. Now if those customers pay back early for whatever reason, then obviously the money that is paid back early flows through to the investor. And I'll draw the picture here very quickly. Let's say that this is the customer who buys the medical equipment, and for simplicity we will skip the seller and we will go straight to the issuer, which is the SPV. So the customer essentially is making payments that flow through the SPV, and then these payments are used to pay off the holders of the asset-backed securities. So this is the investor. If customers start paying back faster than was initially estimated, then obviously the asset-backed securities will be paid off faster, and the interest income will be lower than what might have been anticipated initially. The risk of this happening is called prepayment risk. This is something that we'll discuss in more detail later, but the idea here is that the SPV could issue different bond classes where the prepayment risk is distributed. So these classes might be set up such that A1 has relatively low prepayment risk and A4 has relatively high prepayment risk. The prepayment risk cannot be eliminated, it can only be distributed across the different bond classes or tranches. What I have described here is called time tranching, and again, to emphasize why we do time tranching, this is to redistribute prepayment risk. Here are 2 more important concepts that we'll touch on here and discuss in more detail later: subordination and credit tranching. The question here is that if some customers default, then who faces the most risk? And what we do here is that again we might have multiple bond classes, and this structure is called subordination. If A is the senior bond class or the senior tranche, and B is subordinated and C is subordinated to B, then if there are losses, the bondholders with these asset-backed securities, the most subordinated bond class, they will have to face losses first. Then bond class B will face losses, and then bond class A will face losses. So only if losses exceed 20 million will bond class A suffer. Notice that obviously the risk is highest for bond class C, and therefore if there is credit tranching, then the rate that these bondholders will get will be the highest, and the rate that these bondholders will get is the lowest. The classic principle of high risk, high return is what is being applied over here. Now let's go back to the Harley-Davidson securitization described in example 2, and we are being asked how many bond classes are there in the securitization transaction. If the A1 notes are senior to A2 notes, which are in turn senior to B notes, does the transaction have time tranching or credit tranching? I have reproduced some of the information from example 2. Now notice we are told that we have class A1, A2 and B, and also notice that the interest rates are different. The interest rate is highest for class B. There is no mention here of time tranching. So a sensible assumption here would be that we have credit tranching, where A1 is the senior most and therefore has the lowest risk and the lowest rate. Bond class B is the most subordinated and therefore has the highest risk and also the highest rate. So it appears that what we have here is credit tranching. Let us now look at the key role of the special purpose vehicle. And we go back to our Mediquip example. Let's say that Mediquip decides to issue a corporate bond backed by the various receivables. So what we are saying is, rather than deal with a special purpose vehicle and have the special purpose vehicle issue the asset-backed securities, the CFO says that I simply want to issue corporate bonds based on the receivables. In other words, the collateral for this corporate bond is these receivables. Let's also say that Mediquip has a corporate rating of BB. If this is the case, then the rating of this corporate bond is going to be heavily influenced by the overall rating of the company. Even though there is this collateral, but investors will be concerned that if payments do come in, perhaps Mediquip will use the payments for something else. There is also a concern that if Mediquip is reorganized, then what will happen to these receivables? Will the investors here still have a claim against these receivables? For these various reasons, the riskiness perceived by the bond investors would be relatively high. Since the perceived riskiness and the credit risk is high, the return that investors will demand will also be high. In other words, the credit spread is going to be high. Therefore, the cost of funding for Mediquip is going to be high. Now, let's go to the SPV scenario. With the SPV, the collateral, which is the receivables, are sold to the SPV. The SPV is a separate legal entity. Since this is a legal entity and it owns these receivables, when asset-backed securities are issued against these receivables, those investors who buy these asset-backed securities can be comfortable that any payments that come in because of these particular receivables will go to the holders of the asset-backed securities. In other words, there is this collateral that is legally protected, and because of that, the investors over here in this asset-backed scenario with the special purpose vehicle will be willing to invest with a lower return. Since investors are happier with a lower return, the funding cost also becomes lower. Remember, the return for the investor is the cost for the issuing entity. So that is the main point. Also notice through this discussion that the SPV is a bankruptcy remote vehicle. What that means is, if there is a bankruptcy over here with Mediquip, or if there is a reorganization, that does not impact the special purpose vehicle. As I've said multiple times, that is because the special purpose vehicle is a separate legal entity. As long as the customers who've taken out loans keep making payments, those payments will flow through to the investors in this situation, regardless of what is happening to Mediquip. I now want you to pause this video and read example 4 and then try to answer these questions. Alright, welcome back. So the first question is, how can a class of asset-backed bond have an investment grade rating when Agnelli's corporate bonds do not? Notice that these corporate bonds have a credit rating below investment grade. There are two major factors here. One is the fact that the asset-backed securities are being issued by the SPV, that is a separate legal entity, and this entire discussion now is just a recap of what we've talked about given a real scenario. So since the SPV is legally separate and investors now are only looking at the cash flows associated with the collateral, if the quality of the collateral is good and there is reasonable surety that customers are going to make payments, then investors will perceive this as relatively low risk and the credit rating will be high. The other point is that we do have subordination over here. So if there are some losses, those losses will be absorbed by bonds C and B, or bond classes C and B, which means that to a fair extent the bond class A is protected. So because of this structure also, the bond class A is likely to have a higher rating than corporate bonds. Next, assume that 2 years after the issuance of the asset-backed bonds, Agnelli Industries files for bankruptcy. What is the effect of the bankruptcy on the holders of the asset-backed bonds? Now, since the SPV is a separate legal entity, then even though Agnelli might go bankrupt, the SPV still exists, and as long as customers are making their payments, those payments will flow through to the asset-backed security investors. This again illustrates the concept that the SPV is a bankruptcy remote vehicle. In this section, we will discuss the types and characteristics of residential mortgage loans that are typically securitized. Let's start with a definition from the curriculum. A mortgage loan is a loan secured by the collateral of some specified real estate property which obligates the borrower to make a predetermined series of payments to the lender. The cash flow of a mortgage includes interest, scheduled principal payments, and prepayments. The ratio of the property's purchase price to the amount of the mortgage is called the loan to value ratio. Let us understand this through a very simple example. Let's say that Mr. and Mrs. Smith want to buy a house. The total cost of this house, or the value of this house, is 150 million, of which Mr. and Mrs. Smith already have 50 million, so they need to borrow 100 million. So they can go to a bank and take out a mortgage. They will borrow 100 million from the bank. So this is the bank. The bank lends 100 million to Mr. and Mrs. Smith so they can buy this house. The bank will then show a mortgage asset. So the bank has lent 100 million. 100 million shows up as an asset, a mortgage asset or a mortgage loan on the books of the bank. Typically in the United States, mortgage loans such as this have a maturity of 30 years, which means that Mr. and Mrs. Smith can pay off this 100 million over a 30-year period. Now, interest rate determination, what does that mean? So Mr. and Mrs. Smith have borrowed 100 million. What is the rate that they can pay? Different countries have different mechanisms of establishing the interest rates, and even within a country such as the United States, there are different options. One option might be that Mr. and Mrs. Smith pay a fixed rate of 5%, or whatever the appropriate rate is at the time. This is one scenario. Another scenario is referred to as an adjustable rate, and the term used in the United States is ARM, or adjustable rate mortgage. What this means is that at particular reset dates, the rate is adjusted based on a reference rate or an index. So very roughly speaking, this is like a floating rate bond where the payments or the interest rate vary based on a reference rate or another index. And then we can have other categories such as initial period fixed rate, where the rate is fixed for a certain period, then it becomes, or we can have some combinations of these two, where we have an initial period where the rate is fixed and after that the rate is adjustable. There is also the possibility of having a convertible rate where the mortgage is initially a fixed rate or an adjustable rate, and at some point the borrower has the option to convert into the other categories. So if it was initially fixed, to convert to adjustable. If it was initially adjustable, then the borrower might have the option to convert to fixed. So those are the different interest rate structures. Obviously, whatever the structure is needs to be defined upfront. Next we come to amortization schedule, and this connects with what we have seen in quantitative methods. Next we come to the amortization schedule. In most countries, residential mortgage loans are fully amortizing loans, which means that the borrower pays an equal amount every month in order to pay off the loan. Now let's go back to the $100,000 loan that we talked about. Let's say that this is based on a fixed interest rate of 6% per month. Typically payments are made every month. So if this is a 30-year mortgage and we have 12 months per year, so the total number of periods is 30 times 12, which is 360. The interest rate per month is 6% over 12, which is 0.5%. The value of the loan is 100,000. So in the calculator we can plug in a PV of 100,000. Future value is 0 because this is fully amortizing, so nothing additional needs to be paid at the end. We plug these numbers into the calculator and compute the payment amount. The calculator will say minus because this is opposite of the present value. So what this says is that the homeowner or the borrower needs to pay 599.55 every month for 30 months, and at the end of 30 months the loan will be paid off. Now this payment consists of both principal and interest. The interest amount is the rate, which is 0.5% per month, into the principal outstanding at the start of the month, so that would be 500. And this means that if a payment of 599.95 is made, of that 500 is interest and 99.55 reduces the principal amount. I hope this looks familiar because we have seen this in other parts of the curriculum. In the second month we will start with the lower principal. The payment will be the same, but the split between interest and principal repayment will be a little different. If we create the full amortization schedule over 360 months, then the principal outstanding at the end of the last month will be down to 0. Prepayments and prepayment penalties. Prepayments means that homeowners make payments beyond the scheduled amount. So let us say that after 10 months interest rates fall, and what the homeowner does is refinances the loan. The homeowner will then make a prepayment and close out this loan. That's one scenario. Another scenario is where instead of paying 599 in a given month, a homeowner makes a payment of 1,000. So notice that this payment of 1,000 has three parts. In here is the interest payment, there is a scheduled principal payment, and then everything beyond 599.55, let's just round this off to 600, then 400 would classify as a prepayment. Prepayment penalties. In some countries there might be penalties for making a prepayment because in a sense this hurts the lender. So the exact penalty can vary from loan to loan or country to country. Those penalties will be defined in the mortgage contract. Rights of the lender in a foreclosure. and recourse and non-recourse mortgage loans. These points are important. So let's understand this concept of foreclosure. As we discussed earlier, it is the bank that has lent money and Mr. and Mrs. Smith have borrowed money. What if Mr. and Mrs. Smith cannot make their scheduled payments? In other words, the homeowners default. Then what the bank can do is take ownership of the house, and then the house is referred to as a foreclosed property. The bank can then sell the house and use the proceeds to essentially pay off the loan. So that's what we mean when we say that the collateral is the real estate property, and foreclosure is the process whereby the bank takes over the house, sells the house, and obviously keeps the money that they get from selling the house. Recourse versus non-recourse mortgage loans. Most mortgage loans are non-recourse. What that means is that the bank can sell the house and keep the money from that sale, but the bank cannot go after any other assets that Mr. and Mrs. Smith might have. So if Mr. and Mrs. Smith have an expensive car, the bank cannot go after that other property or the other bank accounts that the homeowners might have. In a recourse loan, the bank can go after the other assets of the borrowers.